Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive. We're jumping right in today, looking at a really key part of the U.S. economy.
Yeah, we're focusing on the lower middle market for M&A and financing. Think transactions generally under that $500 million mark.
Exactly. It's where so much happens, but maybe doesn't always grab the biggest headlines. We want to give you the inside track quickly and clearly.
We do. And we've pulled together insights primarily from the Q1 2025 U.S. Middle Market Monitor. Big thanks to CIBC U.S. Middle Market for putting that together.
Yeah, great resource. It includes data from Robert W. Baird, PitchBook, GF Data, really solid sources.
Absolutely. Our mission here is to distill the most important stuff, the trends, maybe some surprises, anything that gives you that aha moment about this market segment.
And just to be super clear on scope, we're talking U.S. M&A under $500 million enterprise value. And when we get into valuation and debt specifics.
Right. Then we'll often be looking at leveraged buyouts, LBOs, in that $10 million to $500 million range. That's where the GF data numbers really focus.
Okay, got it. So let's start with the big picture for 2024. How did overall M&A activity look in this lower middle market?
Well, it dipped. Compared to 2023, activity was down about 9.5%.
Okay, so a noticeable slowdown.
It was. And, if you compare it to the pre-COVID years, say the average from 2015 to 2019, we're still running about 33% below that level. So it hasn't fully bounced back.
But wasn't there a positive sign towards the end of the year?
Yes, exactly. That's the interesting bit. Q4 of 2024 actually saw a jump. 13% higher transaction count compared to Q4 of 2023.
13%. Okay, that's significant. 691 deals versus 610.
Right. So it definitely gives you a hint, maybe a suggestion, that things could be starting to rebound as we head into 2025.
So what's fueling that potential rebound? What are the factors pointing towards maybe a better 2025?
Well, there are a few big ones. First, you've got just a massive amount of dry powder.
Right, capital that financial sponsors like private equity firms have raised but haven't spent yet.
Yeah. Exactly. Robert W. Baird puts it at over $1 trillion. That money needs to find a home. It needs to be invested.
$1 trillion is a lot of fuel for deals.
It really is. Then you also have lending markets that are, generally speaking, pretty supportive right now. Access to debt financing is crucial for M&A.
Okay. And what about the regulatory side?
There's an anticipation, maybe hope, that the M&A regulatory environment might ease up a bit under the new administration. Less friction there could encourage more deals.
And you also mentioned private equity funds themselves, something about their life cycle.
Yeah, that's another key driver. A lot of PE funds are getting towards the end of their typical 10-year lifespan. They raised money years ago, bought companies, and now the clock is ticking. They have a backlog of portfolio companies they need to sell, to exit, to return that capital to their investors.
So pressure to sell builds up. Makes sense.
It does. But, it's not all smooth sailing. There are definitely headwinds that could dampen things, especially early in 2025.
Like what?
Well, ongoing geopolitical turmoil is always a factor. Uncertainty there makes people nervous.
Sure.
Potential government personnel changes, funding cuts, those can ripple through the economy. And then there's the big one, the weekly, sometimes daily changes and uncertainty around global trade wars and tariffs.
Right. That unpredictability must make planning difficult.
Extremely. It creates a lot of caution for both buyers and sellers.
Let's dig into PE exits a bit more. You said funds need to sell. How did that actually play out in 2024?
It was a bit of a mixed bag, but showed signs of life. We saw a noticeable rebound starting around Q3, according to PitchBook data.
Okay, but Q4?
Q4's recovery was, let's say, more measured. A key reason was still those valuation gaps. Buyers and sellers just weren't always seeing eye to eye on price.
That old problem.
Yep. But what was really interesting in 2024 was the rise of continuation funds CVs. They hit a record level.
Okay, maybe quickly explain continuation funds for listeners. Why were they so popular?
Sure. So imagine a PE firm has a really great company in its portfolio, but the fund holding it is nearing its end. They don't want to sell it yet. Maybe they think it's undervalued or has more growth.
Right.
So they basically set up a new fund, the continuation fund, and sell the company from the old fund to this new fund. Original investors can cash out or roll their investment into the new vehicle.
So it lets them hold on to promising assets longer.
Exactly. It became a really valuable tool last year, especially for those high-quality assets that maybe weren't getting the right price in the open market.
And looking ahead for exits in 2025.
The outlook is, I'd say, cautiously optimistic. You've got pretty healthy public market valuations, which can help support private market pricing. And the potential for easing interest rates helps too.
But still some risks, I assume.
Oh, for sure. Market volatility is always a risk, especially, again, with tariff news swirling. And if inflation fears really hit consumer confidence and spending, that could definitely impact exits, particularly for consumer-facing businesses.
Okay, let's shift to valuations themselves. How did those hold up in the lower middle market?
Surprisingly well, actually. According to GF data, for those LBOs between $10 million and $500 million, the average EBIT multiple stayed pretty steady at 7.2x in 2024.
7.2 times earnings before interest, taxes, depreciation, amortization. Holding steady despite everything. Why do you think that was?
Probably a combination of things. There was definitely a continued shift towards focusing on higher quality, more resilient assets, fewer, maybe speculative deals.
Okay.
Also, a lot of activity was in smaller deals and add-on acquisitions, which sometimes command slightly different multiples. And crucially, lenders, both direct lenders and banks, were still quite eager to put capital to work.
Interesting. Especially you mentioned in manufacturing.
Yeah, manufacturing actually saw its multiple tick up a bit. Lenders seemed keen on that space.
So if rates do come down and credit loosens up more, could we see multiples climb?
It's definitely possible,
Yeah.
especially for those top-tier assets. More competition and easier financing usually pushes valuations upwards.
The report breaks down multiples by sector, too, for deals between $10 million and $250 million. Some interesting moves there.
Yeah, quite a bit of variation. As we said, manufacturing was up slightly to 6.9x. Business services stayed pretty consistent around 7.2x.
But healthcare services saw a pretty big drop, didn't it? From 8.9x down to 7.7x.
It did. That likely reflects a few factors. Increased regulatory scrutiny in parts of healthcare is definitely one.
Okay.
Also, evolving reimbursement models, how providers get paid, creates uncertainty. And maybe some of the, the boom we saw in areas like telehealth during the pandemic is cooling off a bit.
Makes sense. What about other sectors?
Retail actually saw a jump up to 7.4x from 6.0x the year before. Distribution dipped slightly. Media and telecom and technology both saw notable drops. Tech went from 10.2x down to 8.1x.
Wow, tech really came off its highs. Reflects the broader market correction, I suppose.
I think so. Uncertainty hit those growth-oriented sectors pretty hard. It shows how diverse the dynamics are within this lower middle market.
Absolutely. Now, what about debt? How available was it for these LBOs?
Debt levels also held relatively steady. GF data shows total debt multiples averaging 3.7x EBITDA for deals under $500 million in 2024.
Okay, 3.7 times. How does that compare?
It's actually slightly higher than 2023, which was 3.6x, and basically right on the historical average.
Why so stable given the rate hikes we saw earlier?
Well, inflation started to moderate, which allowed the Fed to pause those aggressive rate hikes. That brought some stability. Plus, a lot of refinancing and repricing activity actually helped tighten credit spreads in some areas.
Speaking of loan activity, that side was booming.
Oh yeah, 2024 was a banner year for institutional loans, according to PitchBook. Nearly $1.4 trillion in volume.
Trillion, that's huge. What was the increase?
It was a 253% increase compared to 2023. Massive jump.
What drove that explosion in activity?
Really strong investor demand for loans was a big part of it. Credit conditions generally improved through the year, and borrowers saw opportunities.
Opportunities to do what?
To lower their interest costs by refinancing existing debt or to push out their maturity dates, giving them more breathing room. We saw record repricing activity, $757 billion.
Wow.
And a huge amount of refinancing, $259 billion, up almost 90%. This was especially good for companies rated B-.
The slightly riskier credits?
Exactly. The more competitive market allowed them to potentially get better terms than they might have otherwise. LBOs and M&A contributed too, of course, but refi and repricing were massive.
Any other notable loan market trends?
Yeah, the so-called maturity wall, the amount of debt coming due soon, actually shrank quite a bit thanks to all that activity. And new issue spreads tightened.
Oh, cool.
And dividend recaps flourished too.
Dividend recaps, where companies borrow money to pay a dividend to their owners, often the PE firm.
Precisely. $81 billion of those in 2024. So overall, a very, very active lending environment.
Okay, so bringing it all together for the 2025 outlook. The report mentions cautious optimism, maybe a 10% rise in deal volume according to EY Parthenon, at least for larger M&A. Does that feeling trickle down to the lower middle market?
Generally, yes, but maybe with a few extra spoonfuls of caution. The drivers are similar. Hopes for sustained economic activity, stable interest rates finally, pent-up demand.
Right.
And maybe those valuation gaps starting to narrow a bit. The PE sector seems particularly bullish on exits. EY thinks those could jump 16%. An ACG survey also showed most members expect more M&A activity.
But what are the potential bumps in the road for 2025?
Well, GDP growth is expected to slow down. EY forecasts 2.2% for 2025. It's not terrible, but it's slower.
Okay.
Regulatory uncertainty, even if easing eventually, can still increase due diligence timelines right now. And there's a feeling among some deal makers that there might just be fewer really high-quality businesses readily available for sale.
Why is that?
Some owners might be hunkering down, focusing on stabilizing their operations in the current climate rather than selling. And interestingly, some early conversations with PE partners suggest Q1 2025 actually started slower than expected, maybe down 25–30% year over year in terms of deals getting done.
Okay. So definitely still some uncertainty there. And we keep coming back to tariffs. That seems like a major wild card.
It absolutely is. The potential 2025 tariffs under the Trump administration are creating significant economic uncertainty. The Tax Foundation even estimated potential hits to U.S. GDP and jobs.
How's that playing out in M&A specifically?
It's definitely dampening activity, especially for cross-border deals where supply chains get complicated. EY's data shows it's leading to longer due diligence periods.
People needing more time to figure out the potential cost impacts.
Exactly. And renegotiations are happening. We're hearing about deals stalling in particularly affected industries like automotive and some types of manufacturing.
Could domestically focused M&A do better?
Maybe in the short term, yeah. If your suppliers and customers are all within the U.S., you're somewhat insulated. But the long-term impact really depends on how durable these tariffs are and whether we see significant retaliation from other countries. It's a big question mark.
Okay, one last sector check. The consumer space. How did that fare, and what's the outlook?
Consumer transaction volume actually ticked up about 5% in 2024, according to Baird. But like the overall market, it's still lagging behind those 2015-2019 averages.
And the big factors now.
In 2024, it was election jitters, interest rates, inflation. Now, early 2025, the conversation is dominated by tariffs. What will they mean for prices, for demand?
Is there optimism for deals later in the year?
Some, yeah. If the tariff picture gets clearer, we could see more activity in the second half. But right now, there are real concerns about consumer confidence.
Because of inflation fears linked partly to potential tariffs.
Exactly. University of Michigan data suggests consumers are worried about discretionary income. We might see people rethinking big purchases, maybe trading down to cheaper alternatives.
So, tough environment for some consumer businesses?
It could be, though businesses that might outperform could be domestic manufacturers who are resilient to tariffs. And strong consumer product companies, the ones still showing unit growth and managing tariff impacts, they could actually find a pretty good market in 2025 if they decide to sell.
Okay, so wrapping up this deep dive then, it sounds like 2024 was, well, a mixed bag for the U.S. lower middle market, a dip overall, but that encouraging little rebound late in the year.
Yeah, and heading into 2025, the feeling is, let's call it, cautious optimism, tempered quite a bit by those economic and geopolitical uncertainties, especially the tariff situation.
But despite those headwinds, valuation multiples showed some real resilience, didn't they? And the loan markets were incredibly active.
Absolutely. It highlights the dynamism of this segment.
Yeah.
And again, thanks to CIBC's U.S. Middle Market Monitor for consolidating so much of this data for us to analyze, it really paints a detailed picture of this vital lower middle market.
It does. So maybe a final thought for you, our listener, to chew on.
Given all that dry powder we talked about, over $1 trillion sitting with financial sponsors, and the potential for maybe a slightly less restrictive regulatory environment, how might nimble investors or perhaps savvy business owners in this lower middle market navigate all this tariff uncertainty?
Right. How could they position themselves to actually capitalize on opportunities that might emerge, maybe particularly in the second half of 2025?
Exactly. And are there specific sectors within this market that you think might be uniquely resilient or perhaps present overlooked opportunities in this kind of environment?
It's complex, no doubt, but definitely worth thinking about.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.